At the end of the day, the appraisal is an estimate. Because homes are only worth what someone's willing to pay, you're trying to evaluate a home that's not being bought or sold. Kind of reminds me of when I was a kid. I told my dad, I used to collect hockey cards. Okay. And I had the Henrik Zetterberg rookie card. I was thrilled about this. Every catalog said this card was worth $100. And I told my dad, I was like 10 years old, that I have a $100 hockey card. And he told me it's only worth $100 if someone gives you $100 for it. So that is like the challenge with evaluating properties that are refinances. And so many of our deals are not purchases, that we rely on these appraisers, and they have the best method, right? The comp method. But at the end of the day, there's an opinion, there's an estimate element to it, but I haven't found a better method.
Hey everyone, thanks for tuning into the Canadian Private Lenders Podcast, a show covering the private lending industry, the mortgage broker space, and the Canadian economy. Your hosts are Neal and Ryan McNeil. Enjoy.
All right, everybody, welcome back. It's episode 74 of the Canadian Private Lenders Podcast with your hosts, Ryan and Neal. Neal, how are you making out today, buddy?
Very good. A little bit tired. I was away in Florida for the weekend, so I'm feeling it.
I feel like that's your standard story. A little bit tired, was away somewhere sunny and warm, and just struggling through life now.
This is the standard. It's a standard week. It's every second week.
Yeah, right on. All right. Well, we've got a great guests joining us today. We're going to stick with our theme of Ontario lenders. So today we're thrilled to welcome on James Grantis, the co-founder and director of investments at Hosper Mortgage. So Hosper, household name in the Ontario private space, known for their fast approvals, quick closings, and excellent service. And additionally, lots of awards on their shelf too. So CMP has ranked Hosper as the #1 non-bank lender in Canada as part of a nationwide broker survey. James, excited to have you today, and welcome to the show.
Thank you very much. I've never heard of Hosper been called a household name before. So that's flattering. At least you didn't call us hospice lending. I've heard that more than we're a household name. But yes, people ask me, what do you do? I tell them work for a company called Hosper. They don't know what that is. But I am now seeing more brokers that take notice and are aware of us. So if this is the broker audience, yes, hopefully you've heard of us and hopefully you've worked with us.
Well, if it makes you feel any better, people, when they hear Keystone from us, they list off 10 other companies that aren't us. Anyways, just why don't we dive right into it? I want to hear a bit about yourself, your background. I know you're a fellow Laurier Golden Hawk, so I want to touch on that later in the show as well. But we also want to hear about Hosper as well and your history with the business. I mean, just in general with private lending and your career trajectory.
Yeah, sure thing. I mean, I've been in the business 8-9 years, fell backwards into it. Like I think a lot of people in our industry did. Not a lot of kids grow up wanting to be mortgage brokers, but some end up being that, right? So for me, during my time at Laurier, loved the time at business school there, and I was able to get a job at TD Bank, which was more of a plan that I thought I was heading down, climb the corporate ladder, do that whole thing. But through my time at TD, actually, I met a client who had businesses in Beijing, and just through meeting them and seeing their businesses and helping them with their various businesses, this serial entrepreneur gave me the opportunity to almost moonlight. And while I did my day job at TD, why don't you go to, networking events in the evening, real estate trade shows, that sort of thing. If you can find people that are interested in investing in mortgages, we can make something work. So it was about 3 or 4 months after that, while I was still at TD, and I found myself, getting a deal sent across my phone, and I would go to the stall and, in the bathroom, and I'd be firing off my mortgage deals. It occurred to me like I should probably just be doing this full time. And, that's how I left the business. I left TD and got into the industry. And then, about a year after that, she moved to China full time, and just another kind of coincidence of fate, met people in the industry now that have since been my partner, in the business. And, he had more of a background on the origination mortgage side, brokerage side. I had more of a background on the, funding and financing side. And so it's a partnership. And in the last 8 years, we've just been adding great members to our team.
How was it doing the two? I know you said you were busy running to the bathroom stuff. I have a bunch of friends and colleagues that are in a job right now trying to make the switch into becoming a broker. Do you think it's the right way to do it, or do you take the leap of faith and just hop straight into it real hop?
It's definitely not the right way to do it, but it's not the wrong way to do it. Let me just put it that way. I think it's very fortunate when you have the opportunity to see the runway, to see that what you're jumping into has potential, whether because you're observing the business, it's a family business, somebody in that business. It's not just a pure leap of blind faith. I think a lot of times entrepreneurs, maybe that leap is glorified, but sometimes it's definitely warranted. But oftentimes it's like in my own case, I should say, I was very fortunate to first bank this person and see the validity of the business, then actually get to pilot it myself in the evenings. So that part I think is great. Where I think there's an inherent conflict is when people are trying to, and this was so famous during COVID with the work from home, when people are working 2 jobs at the same time. And that's where I think it crosses a bit of a line. So because I was a banker, I had to be at my job, 9 to 5. I couldn't do the 2 jobs. Hence why I had to go to the stall for 5 minutes if I wanted to forward an email. Because I was really wanted to respect that relationship with my employer who was giving me my start and all that good stuff. So this is the challenge with the industry, but be it mortgage brokers, real estate agents. There's so many people that are licensed that don't do the business. And you'll see all the volume concentrated with the successful people that do it full time.
Yeah.
So there's a both way answer to your question. It's not a right or a wrong way. I just think that at some point you have to make the decision and you got to kind of go all in. That was what happened for me when I just decided, thinking back, I remember thinking I'm going to wait 3 more months to get my year-end bonus. And then at some point I said, what am I doing here? There's such a bigger opportunity to start building a new career versus the bonus that I was leaving on the table, which was in hindsight not substantial, right? So
it's hard though, to your point. It's hard when you get used to a fixed income and that paycheck. Trying to jump to something that's completely unknown is kind of scary. But I think you're right. I didn't think I did engineering and then switched to being a realtor, and it took a minute to be comfortable to do that. But once I made the jump, I'm really happy that I did. And I will say, probably the first year I made less money than I would have as an engineer.
I also made less money. Went from a salary with a bonus, and then I made less money, and then fortunately, made more money. But I the whole time was able to see that trajectory. So it's like if you're joining a real estate brokerage, for example, and a mentor that's doing it, makes it easier. And this is the other thing. So at the time I was in my 20s, no obligations, no family. Now, now I have a kid, I've got a wife, I've got a house. It's the increase in that risk to be able to sacrifice a steady income that's changed a lot. So I think, speaking as someone that, I consider myself an entrepreneur now, although I've never really used that word, but you have to recognize the privilege of having the ability to take that chance. There are so many people that would be capable, I think, but because they prioritize their family or their kids or the paying the bills, they aren't willing, even if they were 95% sure they had an idea that would work, they cannot jeopardize for the 5% chance that they're going to have a month or 2 that their kids aren't going to get what they need. And so that's something that I want to appreciate and respect too, out of the whole process, that so much of it is, often the self-selects people that are hardworking, and so they attribute the hard work, but luck, and that sometimes the privilege of the timing when it happens is so much of the factor as well.
Yeah, 100%. That is a huge thing. I said too.
Yeah, that's we've talked about that before on this podcast, James. It's a really good point you bring up with the risk of making that leap into entrepreneurship or starting a new business, whatever you want to call it. And you're right. Most people who are in similar positions to us with young families and a house and whatever and a mortgage, they're not willing to take that leap. But I'd argue as well, and we've talked about this, that there's just as much risk, if not more risk, for staying with that employer and becoming stagnant. There's risk on your own mental health, but there's also risk of the being at the leeway of that big employer, right? And then corporate restructuring and different things happening as well. So it's just an interesting conundrum, and I feel like more people are starting to take that leap at least in our generation.
I don't know what's better or worse, but I don't disagree. I think it's a choose your own adventure.
It is. Yeah. Self-employed people are the only ones that'll trade an 8-hour day to work whenever they want, which means they're going to work all the time.
Yeah, 16-hour days.
Preach, brother. It's been crazy right now, but that's what you sign up for. Yeah,
absolutely. So interesting note as well, James. It looks like we started in the private space around the same time, about 8-9 years ago. So I'm just really curious to hear. I've gone through a couple different businesses here, but just kind of want to know, with Hosper specifically, kind of what were the key decisions or actions you made to lead Hosper to where it is today as an established private lender?
Well, never risking the business would be, I think, number one. And that's never been more apparent than the last few years. It's kind of crystallized that belief. That's actually one of the vision statements or kind of key principles that I actually still remember from TD when I worked at TD Bank. They never bet the bank. That was the thing. I think that's so smart, to never jeopardize the long run or the foregoing business that you have to do more deals, or to grow the business faster than, it's maybe sustainable. And being it that we started in the same time, I know we're in different provinces operating, but believe your experience might have been the same as mine from 2015 to 2021. It's pretty hard to write a bad deal. And I'm the first to acknowledge how fortunate we were to start when we did. I was never our key underwriter, but our underwriters were fantastic. But even if they were making mistakes in the beginning, the market would have erased those mistakes. And so it wasn't until we had 5 years in the business, we had a pretty good foothold of what we're doing. And we already sort of graduated up that or down the risk curve that we saw the risk more exposed. And now I'm referencing sort of what happened with the interest rate hiking cycle and what happened between 21 to 23, where all of a sudden people are taking losses on private mortgages, and it wasn't as much of the hubris was evaporating a little bit, because for the previous 5 years you could do 85% deal and you get out, even if the client defaults, wait another 6 months and another $200,000 of equity is appearing in the property. So I think that is the one thing that I want to emphasize, is that you never bet the business. You never try to win a deal that could jeopardize the entire business. That's sort of the first thing that jumped out at me when you asked that question.
I guess that everything makes sense there. How did, was volume of deals just immediately available? What did that look like? Branding wise, was capital always there? Volume of deals were always there. There was no push on a branding perspective, or what did that have? What kind of impact did that have on you guys' growth, being the size you are today?
We were very fortunate. So as you know, and probably many of the listeners, if they're part of the industry, mortgages are a very relationship-based industry. Frankly, probably every industry is like that at the end of the day. Branding is more important in some industries. Guys, we sell a commodity. We sell money. We sell money and other people sell money, and there's basis points of difference in our pricing. But really, at the end of it, it is the relationships that are built and the trust that is established. And that's where we were very fortunate, because I had partners. I didn't come from the mortgage space. I came from the banking space, and I was able to bring in some money early, not from family, but just from people that I had met in that year that I talked about networking. I had the partner that brought in a network of brokers that needed what we were doing at the right time. So again, timing and relationships kind of all worked in our favor. But I definitely think, we've received submissions from over 2,000 mortgage agents now, or mortgage brokers and agents. The first year we were relying on 4 or 5. They were just steady producers for us. That was the proof of concept. Okay, we can run a business here. We can operate on this. It was only later that we focused on the branding and focused on getting our name out there. And actually, a quick side funny story on that one. We actually didn't start the company called Hosper Mortgage. We had a different name. The name included equity, like many, many other lenders. I won't give you the full name, because we got a letter from a builder that said they own one of the words that was in our name, that they had a full trademark on this English word. And so we were faced when we went to a trademark lawyer, and he said, well, you'll lose, but you'll spend $100,000, and at the end of the day lose. And that cost is, my bill's got to get paid, and the cost is sunk anyway. So that was really tricky after about a year and a half, feeling like we've built a brand, which was this big compared to the brand we've tried to build now. But at the time being like, oh my gosh, everything is crumbling around me. Like this company that again was just 4 brokers sending us deals at the time. We had to change the name. And that, in hindsight, was a blessing in disguise. Because I think when I named the lending company initially, I was thinking just as an investor about the investors I was going to sell to. And a strong name. I think we had a lion logo, and at one point it was a castle logo. Yeah, it seems great for an investor, but at the end of the day, the investor doesn't care what you're called. They care if they can get a hold of you, if they can call you and you pick up, and if they can trust you, and if you make the money and don't lose the money. The people that actually are more sensitive to your brand, I think, are the people who are being presented your terms by a broker, and they've never met you, and maybe they've only met the broker on Zoom, right? And so that was a fortunate thing in hindsight that we were able to rebrand. And Hosper is a combination of the words home and prosper. We believe belief represents growth and all these things that do still pertain to our investors, but also apply to the borrowers that are coming to us as well. So that's just a little quick, maybe not so quick origin story about how we came up with our branding.
No, it makes sense. I mean, the branding is important sometimes more in other businesses, but for us, I feel like it's like a resume almost, where people just expect you to have it. It needs to be good. It needs to make sense and still confidence. But to your point, it's not going to bring in an investor or bring in a new client, but it will just continue to solidify if they're already feeling good about things.
Yeah, I would agree with that. Absolutely. Yeah.
So when you guys started out, and you were not called Hosper, or were you guys operating as like a pooled fund or MIC, or were you just a direct private at that point? What was your opening look like?
Yeah, same thing. We were same business, same license. We were at that point a mortgage administrator, just a mortgage administrator license, which is the same license we have today. Actually, was going to mention that earlier. We didn't start it as a MIC. We are predominantly a MIC now. Most of our brokers know us as a MIC. We started as a syndicate. Language we call it is a direct mortgage investment. The language we call it, to our investors is we offer direct mortgage investments. Yeah. So we source the deals, we manage them, and we present them as opportunities to investors. It was when we got to a certain scale that becomes less ideal for us operating the business, but also our clients. If you've got 15 mortgages, you're making passive income, right? You don't really want the headache of, this payment's late. Like I got to do my bookkeeping because I'm supposed to collect it on the 10th, but it got paid to me on the 17th. And so that's when the MIC, when we had, again, this was like the next proof of concept. Okay, we know we're going to get 50 deals every month. Like we know that we're going to sustain the business, that it's going to be worth the significant fixed cost to set up now a fund and go through the securities work and the auditing work and go through those audits. So right now we actually maintain both options. Having the direct mortgage side of the business allows us to be perhaps higher or aggressive in our approvals. We approve higher loan to value deals, which is why we're able to get some tougher deals done. While the MIC has a very strict parameter of what we can put in there. So it gives the passive and predictable experience to an investor, but we still have that high yield opportunity for our more yield seeking clients.
And so you intend to continue having both of those fields, or are you leaning towards trying to push everything towards just being the MIC going forward?
I think we intend to keep those. Our goal is narrow. We want to just specialize in Ontario only, residential only, mortgages up to $1.5 million, right? So we have a very, very tight niche from a broker perspective. Like that's what we advertise, that's what we do, that's what we're best at. And because it's so specific, that's why we can close deals quickly. Because underwriters are spending half the day underwriting a commercial or a mixed use property when this is a 30-minute underwrite waiting in queue. What I described just gives us more channels to take that same niche type of product and break it into something that's suitable for the investor, depending on how they want to now fund it.
Do you find most investors want to go into the direct side versus MIC?
I find that most people want to start in the direct side because there's a couple reasons. So number one, the belief that they are on title gives somebody a lot of comfort. A lot of people also like to do what they've done. So I've met many people that are, 60-year-old Italian guys that have been doing this for 30 years. And they're like, I've always lent it this way. I don't get deals directly anymore because the regulations have changed and generally the industry is consolidating. So I'm coming to you, but I still want to get my direct deals. I still want to be on title. In some cases, I still want to drive by the property. So sure, go drive by the property. Just don't knock on the door. Just please don't knock on the door. I would run out of hands at the amount of people that said, I will never invest in a MIC. And now their entire strategy has shifted to the MIC. So the biggest difference, I think, is just the level of trust, because when somebody is buying a direct mortgage from us, especially the person that thinks of it as buying a mortgage, where I don't think of it, I think of it even as like a joint venture, even with a direct investor. But the person thinks I'm just using this company to buy the mortgage. We're there for convenience. We service it, we collect the payments, we'll deal with the notices, renewals, payouts, but at the end of the day, they still hold title. So if something happens to Hosper goes out of business, well, they still have their direct mortgage. You need to have a greater degree of confidence with the manager if you're investing now in a MIC. Although the underlying assets are the exact same, they're still backed by the same pool of mortgages. You're now trusting that Hosper will remain in business, because they're much more complicated if a fund goes out of business than if your administrator goes out of business. You also are trusting that we're able just to continue to get good deals. There might be good deals in the fund today, but if a year later we can't originate the same amount of good deals, then that's a problem. And then of course the ability to know how to manage deals if things go south, or you're no longer looking at the appraisal or vetting each deal. You're putting the faith on the fund managers, which we are, and the offer memorandum that's a little bit more general than a specific appraisal, specific property address, if that makes sense.
Yep. Yeah, it totally does. Just one more on the mic, James. How does Hosper typically approach raising capital? Are you primarily private investors? Do you use institutional capital? Is it a mix of both?
Yes, it's a mix of both. So we've got some bank partners, as many mix our size too, but primarily we deal with direct investors. So we deal just with your, high net worth investors. And to be sure, accredited investors generally have, $1 million net financial assets. And these are people that are coming to us that are saying, hey, look, I'm looking for an alternative to what's available. I can't be 100% concentrated in the stock market, or I've been in real estate my whole life. I've owned rental properties, but I'm getting a little older. I don't really want the headache of being a landlord. Let me trade in being a landlord with owning mortgages, and I'll trade in my rental income for interest income and the hot water shut off of someone else's problem.
Feels like a similar story to what we're seeing.
It's what we're feeling right now. Everyone's kind of getting tired of dealing with the tenant situation or management, and that passive income idea, it's not so passive.
And that's at the end of the day, that's the core of what we're trying to do is to keep the passive income passive. Keep it predictable, keep it passive. Basically, let your money work for you. Secured by real estate, which generally a lot of people have comfort with. And then we have the scale and the tools to make it a lot easier. If I may, I'll just tell you another story on that topic. I think you might appreciate it. The first couple of years in the business, we used to do everything like the traditional way or the legacy way of posting checks. And I remember trying to convince my investors that we'd move away from posting checks and move towards direct deposit. Because after a year of doing it that way, the business just evolved into just couriering checks back and forth because someone misses an initial, there's a late payment, somebody goes on vacation, but then they deposit the check on the 20th, and then borrower's like, well, why would you pull my money on the 20th? I was supposed to pay it there was money in the account on the 1st. And so everything just ground to a halt with the check-based process, which was again the legacy way. I believe it or not, some people are still doing it that way. So having the ability to pull electronically, we're set up as like a bill payee. So borrowers can pay us like they pay Rogers, and it takes that friction out of it.
You were taking checks directly from the borrower and then handing them to the lender.
We were in the first year that we operated as an administrator. That's correct. We were on closing. One of the requirements of closing was, handwriting checks, right? And if it was a 1-year mortgage with 3 investors, this borrower is sitting in their lawyer's office. They're writing 36 checks. And so they ran out after 25. Now you got to courier the other half. And then, somebody doesn't deposit on time. The check-based, manual-based process, that sort of traditional way of being a private lender individual is definitely dying off. And I can definitely see the industry is consolidating into companies that are licensed administrators. And then that's only been exacerbated by the AML rules that launched in October. Right now, Canada has pretty much made it illegal to be a individual private lender, because if you're an individual private lender and you're not doing your FinTrack reports, if you're looking at Equifax reports and you're not a licensee of Equifax, if you're not, doing the ID verification, there are so many AML requirements now in our industry that it's basically made being an individual private lender almost illegal.
Yeah.
So it's sort of kind of accelerated this consolidation that was already happening. I don't know, maybe do you guys agree with me? Are you seeing the same thing?
Couldn't agree more. And it makes me think too. I mean, we were introduced through our friends at Mortgage Automator, and that's, completely changed the industry. And, I can recall back to when I first came in, not even 10 years ago. And, we were not only using an Excel file with 40,000 lines on it to track every mortgage file and its 12 monthly payments, post-dated checks. And also, I don't know how you guys operate now, but we do at Keystone, we do once per month, pull our borrower payments, right? On the first of the month, we pull borrower payments. We used to pull whenever the closing date was, just a month out, and every following month we would pull. So you'd be pulling every day of the week. You'd be pulling mortgage payments in, and like you said, James, with AML layered into this as well. We're extremely fortunate to have great technology partners now that alleviates a lot of this admin burden and luckily has simplified things over the past couple of years.
Is this our 30-second commerural for Mortgage Automator? Because they've helped us.
Exactly. I'll expect their check in the mail for this one, Joe.
That's right. So we, again, I'm actually you got me down on this trip down memory lane of the beginning days of this company. That same thing with what you mentioned about keying in the payments. we used to, Mark on my team, who's still, on our team today, used to individually key in on TD Bank, like the banking information of every single borrower, which made sense when you had 50 borrowers. Then it quickly got to 200. And so eventually it became a question of, can I get the payments done before 11:59 when it goes to the cutoff? And he would do it literally till midnight. And so that shift to automation, that shift to the batch file and being able to upload, it was hard, admittedly, because the system that he had, he knew it worked. And it's such a critical thing, not pulling the wrong amount or paying the wrong person, because we got to remind ourselves, we're dealing with real cash. This is somebody's money we're moving around. And so that hesitance is still very tangible to this day. I know we need to switch, but I'm so nervous to try because at least I know this process works. And I think any growing company learns they have to go through that. You have to give up what works, because as companies evolve, you kind of have this constant, what worked at 10 people doesn't work at 20. What worked for your company at 20 people doesn't work at 30. And that sort of cycle just continues.
Absolutely.
That's insanity. That wasn't that long ago. You guys were on like
that's crazy. Yeah, it blew my mind that we're still doing that, but luckily times have changed. James, want to dive into Hosper specific strategy. So I know you mentioned already, you guys specialize in Ontario residential loans, but curious, can you expand on that in terms of like geographic regions? Like, are you in Northern Ontario? Are you in Southwestern? Are you in Eastern Ontario? And kind of like how you differentiate. And I know as well, you mentioned, res, but do you guys dabble at all in anything commercial, like whether it's like multi-unit or mixed use? Can you kind of touch on your strategy?
We're simple. Like, we are very simple. Our strategy is residential, single family homes. They're all asset classes. We'll lend on condos, detached, semi-detached, everything, right? But typically these are non-luxury single family homes. And we lend all over Ontario. We have deals like far north. We have deals near Winnipeg and Kenora. We have deals in Thunder Bay, Timmins, cool. All the way to Sarnia, London, Ottawa, and East. So we pretty much cover the map in Ontario, and that's possible because we have boots on the ground in most of those major centers. So clients ask me this all the time, like, "Oh, are you sure you want to? We should. I don't know about this deal in pick a city, right? Windsor. That'd be a bit far for me to go to." And I ask them, like, "When are you ever going to go to property?" That's not the way that this process, that doesn't sound very passive to me. Even myself, I live in Etobicoke. If I lent on a mortgage in Etobicoke, I'm not going to be the one going to the property. Although I do sometimes visit with our contractors. It's our team of project managers and contractors that actually go and visit the properties. So that doesn't necessitate that we only lend in a 2-hour radius. Like I hear other lenders advertise 2 hours from Toronto, like as if like hours is like the currency that you measure where you should lend. It's interesting.
Is that traffic dependent too?
But yeah, so 2 hours in Toronto means you're lending in Toronto, basically.
Yeah, exactly.
Cheap shot for easy one there. But the idea is we are the hub as the like we all work for the same office. That's another thing that I feel very strongly about as a lending company. It's kind of, maybe your companies are different, but our company is not a remote company. We did that experiment and we learned that on the other side, being in the office together is a huge advantage. And we have another advantage with that is that our law firm that we work with is in the same building as us. But then everybody that's critical to our business, but that's outside of our business, like our home inspecting partners, our renovation companies, our realtors that we work with, they're all dispersed in the locations that we lend. And so just as you wouldn't use the same appraiser in Ottawa as you would for London, like we use different companies when we need to service different properties. So that was a long way of just saying we do lend all across Ontario, but our key constraint is the loan size. Like we don't do $3 million loans. So typically $1 million, $1.5 million. First, second, third, doesn't matter as long as the asset is a single family home. And we are the type of lender that is equity based. So we are scrutinizing the asset a lot more than the person. And that's our niche, and that's what we're sticking to.
Why the decision to stick to that loan size? Like for us here, it makes a lot of sense because it's property sizes, but like where you are, like average price point's what, $1.5 million?
Yeah. So speaking lender to lender, it does mean we get priced out of core Toronto properties a lot. It's hard. There's the average Ontario property, but you put that in Toronto and it's $2 million. It just looks like, like an average property, right? It's wild. But the biggest reason behind that is because we are Ontario wide, we certainly are happy to lend directly in Toronto proper. But there's also lenders that only lend in Toronto proper. And because that's their niche, they're priced accordingly. And so what we're built to do in approving and funding deals quickly and lending across Ontario means that there might be a better lender who's going to do that $2 million loan, in Ontario. The second thing is, again, speaking lender to lender, is like when you get behind, someone's taking a $3 million private mortgage, like it's not hard to understand why someone might start missing payments if the payments are $23,000 a month.
Uh-huh.
You know what I mean? And so our business is built on ability to process thousands of smaller loans. Our typical loan size is less than 200,000, which might seem high, but relative to Ontario lenders, I think that's probably small. We do plenty of $80,000, $90,000, $100,000 loans. And in those cases, if the client's payment is $600-$700, there's still consideration there, but it's a lot. This is common sense, but it's less likely someone's going to lose their house over a $600 monthly payment than a $23,000 monthly payment. And we have seen that firsthand. And it also ties back to the thing I said at the very beginning of our chat, is just about never betting the business. And when you start doing $2-3 million loans, if those go sideways, it's very different than a $100,000 loan going sideways.
Is there consideration associated with the administration cost of the work of a smaller loan? Right, that's something we've talked about a bit sometimes, is just when there's a certain loan size where you're like, this is a lot of work for little to no profit that potentially technically doesn't really cover all the overhead and burden that it takes to get there. And if something goes sideways, we could really be losing money on this.
I used to think a lot more about the marginal benefit of each dollar we earn. I think a lot less about that now. I think about just continuing to provide solutions to the broker that we work with. They should make this clear. 100% of our mortgages are originated by mortgage brokers. So we don't advertise directly to clients. Like, we rely on our broker partners through a portal that we use, a mortgage automator, just so we get one more check in the mail there, to submit these deals to us constantly, right? So if we said, thanks for the submission, but it's a $30,000 mortgage and we're only going to charge 2%, like it just doesn't really worth it for $600. Like, that's starting to potentially jeopardize that relationship with the broker. So I think we kind of look at it both as like a holistic value of relationships with our brokers, less like the individual cost of the deal. But to be sure, that is a consideration. You can't be operating non-profit, but it's the same way that when, if something goes sideways and you need to waive fees or, you lose money, it is the cost of doing business. Our inventory is money. Same way that any business that has inventory is going to have some breakage. Personally, I've learned you can't get too long. And that's actually learning has happened more recently. I used to be a lot more fixated on, and I think that's even actually been exemplified even more in the willingness to not do deals. So I know I'm making the counterpoint now, but I would do a small deal if it was for a broker that we have a good relationship with. Mm-hmm. I would also not do a very lucrative deal that could make us money, just because I don't think it's worth it to get into business with that brokerage. They don't have a good reputation. There's something untoward going on. That's kind of in both ways. I look less at the profit on each deal when making the decision, and then rather what's just good for the overall business. And if you're just focusing on growing the overall business, then at the end of the day, there should be money left over.
That makes sense. And I think we have a similar mindset. I have to catch up. I was just going to say, the reason I asked too partially is because every person that I've talked to in this business is always like, so why don't you guys do bigger commercial loans? Like, you want to place that big chunk of money, you want to get that big fee. So it's just interesting to hear your, I don't want to say counterpoint, but that mindset, because I agree with it. And I think it makes a lot of sense. And I've always felt those big loans I think they have more probability of going sideways sometimes. But yeah, I think there's a nice thing in having a base of a high quality of loans, because even if a few of them go sideways, it's not the end of the world. Pretty much stays true to the theme of never bet business on one deal, right? Like, if you start getting into those bigger deals, it is tempting. It is tempting at the time, but if you make a 4% fee on like a $2 million, seems like a phenomenal. It is a substantial amount of money, but if you lose any of that $2 million, it can quickly be not worth it. Or if your business can't sustain it because that's not what you're cut out to do, and you get distracted from your core, I think just sticking to the niche. There are other players who that is their niche. Like, they are clear that they only do big loans, and they're where we want to do 100+ deals a month. They are happy to do 10, but they're placing bigger deals, and that's
That's what they're built for. And if that's what you're built for, then yeah, of course, that lender would turn away the $50,000 deal because that's not their niche. We're really trying to focus on the opposite, right? The smaller, faster, simpler deals. That's what we focus on.
Honestly, it sounds like there's quite a few similarities with our businesses with Keystone out here in Atlantic Canada, and I like to call it we do singles and doubles. We don't try to necessarily swing for the fences all the time. So it's also a couple of comments on a couple of things you mentioned there. So we're also exclusive mortgage brokers. 100% of our leads come through mortgage brokers, or if we get a lead, we send it out to one of our broker partners. And we just had one 2 weeks ago where it was I think it was a $75,000 second mortgage. And it was like a pretty borderline deal, but I'd had nothing but an impeccable track record with this broker. So we just said, we're going to go and we're going to do the deal. But if that had come from, 9, 10 other different brokers, it probably would have been an immediate turn down. So it's just kind of interesting. It kind of comes back to the relationship-based business that we're in. But I thought that was very interesting. And just quickly back to your how you guys evaluate your assets. So you'd mentioned you've got, contractors or site inspectors that go visit the property. Do you guys use appraisals for each property you do as well? Or does it depend on geographic area? Like I know some lenders, especially, if they're Toronto based or GTA based, they might have someone that goes to every single property and they might do that in-house. That's not viable for us out here because we're lending all over 4 different provinces in Atlantic Canada. I know you're lending over a huge geographic region across Ontario. So just kind of curious about the valuation approach.
We believe in appraisers and we use appraisers 100% of the time. So we only accept deals. We'll only fund a deal if we have an appraisal from an accredited, but also we maintain our own list of approved appraisers. So there's hundreds of appraisers in Ontario. Our list is maybe 30, right? And there'll be different appraisers that we'll recommend in the north as, different areas, right? And I think that's been like key to the whole thing. When you're doing volume with the appraiser, then it also does become a little bit closer to that relationship in-house, right? It is still a third-party company entirely. They have their own insurance and licenses and all that, but this is our 300th appraisal from a company this year. If we need to get a hold of them because we're confused why they left out a specific comp, or, they didn't do time adjustment, but it's been a year, then we can just pick up the phone and call them the way that you would call your home inspector who's on the payroll. And so I think that gives the best of both worlds. Speaking candidly, like I do speak with investors who love to disagree with the appraiser. I had a conversation yesterday, actually, now that I think about it, with this got escalated to me through one of my account managers, and they just didn't believe that they didn't agree with the appraiser. And we had the whole conversation of, at the end of the day, the appraisal is an estimate. Because homes are only worth what is someone's willing to pay, you're trying to evaluate a home that's not being bought or sold. Kind of reminds me of when I was a kid. I told my dad, let's collect hockey cards. Okay. And I had the Henrik Zetterberg rookie card. I was thrilled about this. The catalog said this card was worth $100. And I told my dad, I was like 10 years old, that I have a $100 hockey card. And he told me it's only worth $100 if someone gives you $100 for it. So that is like the challenge with evaluating properties that are refinances. And so many of our deals are not purchases, that we rely on these appraisers, and they have the best method, right? The comp method. But at the end of the day, there's an opinion, there's an estimate element to it. But I haven't found a better method. I just haven't found a better method. There's no practical way for us to go to every property across Ontario. And even so, we are not appraisers, right? We're mortgage people. We can do our own comps and searches and come up with an estimate. But having that third party accredited appraiser corroborate that estimate, that's what gives us the most comfort.
Love it. That makes sense. We follow the same principles. Also, I want to start by saying, if you're one of the brokers that sent us over a deal for $75K and Ryan said, no, it's not because we don't like you, we just keep sending us deals.
I should have clarified that.
There's something blatantly wrong with the deal.
It was a borderline deal, is what I'm saying.
You borrow or socks. Anyways, let's switching gears a little bit. What's it like in Ontario right now, in the lending world? Is there a lot of volume of deals? People still like being able to get refinances done? Like what's that world look like? I think I'm starting to see that Canada is so nuanced. And so what we're experiencing here in Atlantic is really not reflective at all of what's going on pretty much past the New Brunswick border. So I'd be curious just to get your take on what's happening there, what's going on. Is there still a lot of growth like we saw in the last couple of years? Is there pain? I know the last 18 months has been a lot of talk of pain. So just, if you can share some of that, that'd be super interesting.
Sure. So first of all, the same thing that's different between Atlantic Canada and Ontario is the same within Ontario. If you're lending in, Barrie right now, it's very different than if you have a downtown Toronto condo. So this whole market's up, market's down headline, like the market doesn't exist as a thing. Okay? It's a collection of things. Even home price index, which I follow, and I just saw that February was the first month that it's kind of down a smidge. It's so different depending on across asset classes, across location. And I think COVID was a fantastic example of that, where you had the RIM, the 905 out of the GTA, growing way faster than the GTA. GTA then held its value as everything else started coming back down. So your first question was, is it busy right now? For us, it is busy. We're feeling that a little bit busy. It's really hard to distinguish, and this has been hard for the users doing it. How much of us being busy is that the market's busier, or that finally some of the things that we're doing, our marketing, our pricing, our formulas working a bit more? I think it's probably a bit of both right now. I think also the fact that there is maybe a bit of uncertainty in the market. I think more people are maybe turning to private mortgage as a solution that never needed to before. And that trend will probably continue. I think you'll probably see more people borrowing privately this year and next year, especially if what we got going on with the United States and the tariffs and how that affects our economy. If that continues to happen, there could be someone that's always been a bank forward, but their industry was hit really hard, and all of a sudden they need a second mortgage for the first time in their life. And so that represents a risk to us as private lenders, because of course the asset value, collateral is so important to protecting our investment, but it also represents an opportunity. If you have traditionally bank borrowers coming to us for the first time, now we're actually having the opportunity to lend to better stock of borrower, all things equal. Mm-hmm. And then in terms of the pain that you asked about, for the first time in 2+ years, things are looking better. I say that cautiously because I don't want to get recorded saying things are great and then we take another tumble. It was the toughest between 2023 and 2024 were the toughest years that we've had as private lenders, even though the net return was the highest. So we had zero losses across any of our loans in the first 6 years of the business. But even the few losses that we did have across the last 2 years were offset because interest rates were so much higher that we were actually making more in totality than the losses that were felt. So we're now at the first time where for a few years there, we were just only accumulating enforcement files. We were starting more enforcement files than we were finishing, in part because that process to get to the possession and sale stage takes so long. There's just months where you can only add to the queue and you just can't start resolving them. But now 2 years into that cycle, we're now selling more properties or exiting more properties, or borrowers are resolving their defaults at a rate faster than we're starting, which is an encouraging trend. Yeah, and I think the trends that we're experiencing are generally echoed. Like it's just generally the same as our other peers in Ontario. I don't think we do things substantially. We have a couple of niche things that we do, but ultimately, as I said earlier, it's a commodity. We lend on the same type of properties as many of our lender competitors.
Does the man with yellow hair south of the border cause any concern for you?
We don't spend a lot of time making decisions based on what we think might happen. We don't try to make our decisions based on our predictions. We've never done that. We don't try to predict, actually. We try to position and we try to make sure that we have enough plans A through B, C, D, E, that if something happens, be it good or bad or completely out of left field, we can maneuver that. So the answer is, I know something's happening. The net result of these forces at play, I don't even know if it's guaranteed to be net negative. We just saw the Bank of Canada drop their rates again. Would they have done that without what's going on with the United States and these talks? I don't know. Sure, certainly lower rates help us as a lender, help generally prop up housing. So there's that force. And then the flip to that is these rates are coming down because there are some cracks in the economy. And a bad economy is, not good for lenders. It could mean that more people are in a tougher financial situation and they default on the mortgage, not good for us. But then the flip that I mentioned earlier is, well, now you have borrowers that are coming to the private space that are a higher quality borrower, that are higher grade. They were always a bank borrower. So you have this stacking of forces, some very positive, some very negative, and it's hard to predict with certainty which side is going to win out. Mm-hmm. And so we're very much we observe, but try not to predict. And we just try to react as quickly as possible to the changing landscape.
Do you think you've changed how you're operating at all in preparation for this, or based on what you think that changed?
I think we've remained more cautious than we would have because of this. So we are less, we're less turning the engines up to 10. We're less just opening the floodgates. That's the way that we are protecting ourselves. It's less business today. We're doing less deals than we could have, just because we'd rather make sure that the big picture is protected, that we can continue to operate. If there's another, dip in the road, if there was another 20% correction in housing like we saw coming out of the COVID, spike, we can manage that. If we went full bore right now and then that happened, then that might put us in a harder situation.
Just one more before we're going to hit you with the bonus question after this one, James. Okay. But last one here. What do you love most about working in the mortgage industry?
I feel very little passion about mortgages themselves, right? Mortgages are, as I said, a commodity. What I love about it is that it's a concept that is relatively simple. Most people understand what a mortgage is, and it allows me I'd like to just educate people about what we do. So the product that we sell is not something that I wake up excited about, but what I get to do is very exciting. And I've yet to get bored talking about mortgages or explaining loan to value for the 1,000th time to somebody, or, how a loan loss reserve works. Like, it's just, I guess, just the idea that this simple commodity, mortgages, has put me across the table with so many fascinating people. The single biggest privilege that I have running this business is that across the table as an investor, usually is the person across the table for me, somebody that made money in another simple or odd or boring thing, like hanging millions of sheets of drywall, or, selling the cap of a bottle, like selling being a drink importer, like all these obscure and unique things. And to them, if I stay in my lane as just a mortgage guy, I get to be like an expert in this very, very little sliver of a thing. To all these successful people in their own right. And so I've been able to just sit and have all these mini mentors that, knowing what they do, I'm kind of become a guy that knows a guy. So, if I know, I don't know anything about Italian suits, but one of my guys custom makes Italian suits. So he's just how smart, I know who to text. And that's the privilege that mortgages has given to me. And that's what I think is why this will be my career, why I'm going to stay in it, because using the simple thing, I've been able to meet so many interesting people. And there's a callback to what we talked earlier. At the end of the day, business is about relationships.
Most people just say it's the people, which is fair. It's awesome. You get to meet a lot of great people in the industry, but I really love the fact that you said that you're not bored doing it despite it being commoditized. I've worked in multiple industries and I don't think I've been bored for one day since coming into this industry. So it's really interesting to hear your perspective there.
100%. So the bonus question is, what is loan to value?
Can I give you this is the simplest way I've figured out how to say it.
Yeah.
That's not the bonus question. Well, let's get that. Everyone knows loan to value.
Give us your answer.
Well, I struggle to simplify it. So it's the value of a property, the value of the loan relative to the value of the property. I always use a $600,000 first mortgage over $1 million property with a 60% loan to value. That's the simplest way I've been able to explain it. And then if I'm in front of a whiteboard, which I prefer to be, draw the house.
Lessons with James. Thank you.
There we go. Yeah.
Love it. No, that's great. I feel like we don't define things enough on our podcast. I'm sure we would do a future episode just purely on definitions.
Just a 1 hour glossary. A 1 hour glossary of you guys defining
exactly.
PO, TDS, LTV. This is
for sure. We'd have to do a 3-part episode. Okay, James, bonus question. You may have heard this one before. I stole it with pride from the Automator guys back a couple of years ago when they used to run their podcast. But so the question is going to be about pizza. Okay, so most people we have on here most people enjoy pizza in general. I guess I'll make that assumption. I know you live in Etobicoke. I used to live in Etobicoke, beautiful area in Toronto, but I think I'm going to go towards Laurier since we're both Laurier grads. So I don't know if that's going back too far, but no. Can you give me your favorite pizza from the Waterloo or the KW region? And I hope it's going to be Campus Pizza because that's the only one I can remember.
Not Campus Pizza. It's Pizza Maniac, extra large Pizza Maniac with a pepperoni and green olive. I'm ordering it around 8 p.m. I'm eating half of that pizza for dinner. And then around 3 a.m., as I'm up studying, in the campus. I'm eating the second half of that pizza. And then usually the exams were not 10 a.m. in the morning, have a coffee, go to the exam. That's a beautiful time. Full pizza didn't even bother me. Next day, play basketball, doesn't matter. I wouldn't try it again. I wouldn't try eating a large pizza in a day anymore.
I love up till 3 for a 10 a.m. exam.
No, I found that the all-nighters, I think I knew the janitors in the business building at Laurier better than the professors. And I think it was a fine way to learn, because today you need to learn something. You have ChatGPT. We didn't have that back then, but you look something up. You didn't have as a business owner, you don't have somebody to go ask the questions to as readily. And I think it was a beneficial experience to mostly self-educate through the textbooks and stuff versus listening to the lectures.
100%. I'm with you. Yeah. That's a good way to say that. You skip class and ate pizza all night. I get it.
That's right. That's right. Dreamed of LTV and didn't know that would come in the future. So guys, it was a pleasure joining you. Thanks so much.
Yeah, some top-notch answers there to wrap it up, James. Really appreciate your perspective. Super cool to hear about Hosper and your history in the industry. Anything else for us before we wrap here?
No, I can't wait to meet you guys in person. Thanks for inviting me on. Congratulations on your success and the podcast you've done. Stick with it. It's enjoyable to be a guest, and we'll chat again soon.
Absolutely.
Thanks, James.
Thanks, James. And thanks, everybody, for listening.
Thanks for listening, guys. It's Neal, your co-host and co-founder at Keystone Mortgage Investment Corp and Director of Investor Relations. I'm also a real estate agent, real estate investor, and business owner.
And your co-host and co-founder of Keystone Mortgage Investment Corporation, Ryan McNeil. Keystone MIC is licensed under the Mortgage Regulations Act of Nova Scotia, license number 3000844, and through FCMB, license 89280. Keep in mind, the views of this podcast are for informational purposes only and are not financial advice.